Taking a small account and maxing out your leverage isn't trading. It's a mathematical path to total failure. 70 to 80% of active day traders lose money over a 12-month period. Most don't fail because of their charts. They fail because they ignore the arithmetic of account survival. In the Bitcoin perpetual market, a mere 1% adverse move at 100 times leverage triggers an instant liquidation. The exchange seizes your collateral because you've left no room for the asset to breathe. To trade BTC USDT sustainably, you must risk exact fixed dollar amounts. This approach decouples your risk from your leverage and removes the threat of an account wipeout. Moving from high-stakes gambling to professional operation requires a rigid mathematical framework. It starts with the math of ruin. Risk of ruin is the probability that your account hits a catastrophic drawdown threshold before your strategy has time to succeed. Risking 10% of your capital per trade means 10 losses wipes you out. By contrast, a 1% model absorbs 100 consecutive losses. For a $1,000 account, a 1% cap means losing a maximum of $10 per trade. Capping your downside is your structural defense against market volatility. It ensures a normal sequence of losses remains a minor setback, not a career-ending event. To protect that $10, you cannot use an arbitrary exit point. Your stop loss must be placed according to the actual market structure. Bitcoin pulls back into a bullish order block. Placing a stop inside leaves you vulnerable to a liquidity sweep. The distal line is the absolute lowest wick. Placing your stop below that line creates an exit exactly 1% away. This ensures you only exit when your trade thesis is objectively proven wrong by the market, rather than being shaken out by noise. Most traders start by picking their leverage first, then hope the trade works. Professional risk management does the exact opposite. Find your position size by dividing your dollar risk amount by your stop loss percentage. For this trade, dividing our $10 risk by the 1% stop distance gives us a total position size of $1,000. Now we apply leverage. Leverage is just a margin tool. With 10 times leverage, you only need to provide $100 of your own capital to control that $1,000 position. Because the position size is fixed at $1,000, hitting your stop loss results in a $10 loss, regardless of whether you used 5 times or 50 times leverage. When setting up the trade, select Isolated Margin. This firewalls your account balance, ensuring a single bad event cannot drain your entire wallet. You then input your entry price, your calculated position size, and most importantly, your hard stop loss before you click buy. Once you are live, you will face the urge to move that stop loss lower as the price approaches it. This is loss aversion, and it is the most frequent cause of account blowouts. Widening your stop is a math failure. If your plan requires a 1% stop, but you drag it back another 0.6% to give it room, you increase your total loss exposure by 60% on a single trade. Sticking to your predetermined exit without emotion is the ultimate test. It is exactly what distinguishes a professional operator from an impulsive gambler. When you trade this way, you create a structural safeguard. A hard stop loss always triggers to protect your capital before the exchange liquidates your position. Follow this checklist. Cap daily losses. Risk a maximum of 2%. Use structural stops. And calculate position size before entering. Use a demo account to practice these calculations. Build the muscle memory of entering orders and setting stops without hesitation before risking actual capital. Prioritizing capital preservation through strict mathematical rules is how you ensure your strategy survives long enough to actually pay off.